Hi guys, welcome back to the YouTube video. In this video, I'm going to do something that I don't actually think anyone's ever done before. I'm going to, obviously, you know me, chartered tax advisor. I'm going to put some prompts into ChatGPT and test the accuracy. We've got 7 questions I've thought about before, and I've not typed these into ChatGPT, I promise you that. And I'm just going to, evaluate their response, because a lot of people now are getting tax advice from ChatGPT. Clients coming to us and ChatGPT said this, is that right? So actually, let's put it to the test and see if ChatGPT is accurate when it comes to helping you pay less tax. So let's load up ChatGPT now. We've got a couple of questions here. So the first one is, I'm a new property investor earning £50,000 from my job. Should I buy a property in my own name or a limited company? Usually this one's relatively straightforward. Of course, it depends on a few different personal circumstances, whether you're married, got children, how the company should be set up, what your future investment objectives are, or if you're going to leave your employment. And I suppose even before going ahead on this is almost, without kind of tainting the video, this is kind of a gap in ChatGPT's logic. Is you are asking ChatGPT the questions. We'll see here if ChatGPT put those considerations forward, but actually any good tax advisor would. So it's just loading the response now. So whether you should buy a property in your own name or through a limited company depends on your goals, tax positions, and long-term strategy. Not bad so far. Since you're earning $50,000 from your job, here's a breakdown of the pros and cons for each route for someone in your position. Okay. Buying in your own name. Simpler setup, cheaper to run, no company admin or annual accounts. Okay. Access to capital gains annual allowance, £3,000 and 24.25. Okay. Mortgage interest relief is given at a 20% tax credit, basic rate only. Cons, rental profits added to your salary, potentially pushing you into the higher tax band. No ability to deduct mortgage interest in full, harder to pass on wealth tax efficiently. In your case, you're already at the 50,000 salary mark, so just 270 more rental profit would tip you into the 40% bracket. Mortgage relief is restricted, so tax bills will be higher if heavily mortgaged. Okay, so then we've got buying through a limited company, pros and cons. So it's quite generic advice at the minute. There's not much consideration, and it's only giving you information for you to make a decision. It's not telling you, straight to the point based on your circumstances. So buying for a limited company, pros: mortgage interest is fully tax deductible. Profits are taxed at 19 to 25%, not personal tax rates. You're in control when and how profits are taxed. This gives planning flexibility. Yeah, absolutely. I agree with all of this so far. Better for long-term reinvestment and scaling. Spot on there. Cons: no capital gains tax allowance on sale. Full gain tax at CT rates. Yep. More admin, annual accounts, corporation tax returns, bookkeeping. Yeah. Higher mortgage rates and more limited lender options. In your case, if you plan to build a portfolio and keep the profits in the business to reinvest, the company route may be more tax efficient long term. You'll avoid being dragged into higher tax on rental profits. So summary recommendation: if you're buying one property, plan to sell soon, and aren't heavily mortgaged, personal name might work fine for now. I suppose for now, we need, when it comes to property structuring, everything's been pretty okay so far, but when it comes to structuring, for now, we don't think for now when it comes to tax, we think for long term. Because the last thing you want to do, buy a property in your own name, a couple of years down the line you think, I need to move this. Well, actually then you've got stamp duty, CGT, getting it into a limited company in the future. Or if you're building a portfolio using leverage or want to reinvest, a limited company is likely more tax efficient. So actually, the response isn't too bad, but it doesn't really help you too much. It doesn't give you a lot of advice, doesn't give you a lot of guidance. But overall, if I had to rate that response out of 10, I'd say probably 7 out of 10. But for somebody who's new into property, that doesn't replace having a consultation with a tax advisor, because there's so much more to it here. Well, actually, the first thing we'd do is ask, okay, what's your plan to pass the property on? Do you have children? Are you married? A normal limited company is great, but actually let's look at a family investment company or a smart company where you've got different share structures to give you that income tax efficiency. There's a lot of gaps here that ultimately ChatGPT might give you something, but there's still a lot to be filled, a lot of gaps to be filled to keep you tax efficient, give you that best structure that in this case, a tax advisor might be the best option. So we've got a couple more questions. What one have we got next? So what's the most tax efficient way for me to take money from my limited company? Let's pop that in here and see what we get. So the most tax efficient way to take money from your UK limited company depends on your overall income level, lifestyle needs and long-term plans, but here's a general approach that works well for most business owners. Pay yourself a low salary. Set a salary at or just above the national insurance threshold, e.g. 12,570 or 9,100 depending on circumstances. So here's the first one that it's got wrong. It doesn't know that the national insurance thresholds have dropped. So of course you've got the employers and I threshold last year, early last year, that was changed. So it was 9,100, but actually for this tax year it's just 5,000. So if you were to rely on that, you could be paying more national insurance than you need to. But moving on, this salary is tax deductible for the company and keeps you in the system for state pension and benefits. True. No income tax or employee NIC if structured carefully. Yeah, of course, you've got 12,570 employee national insurance threshold. And then we've got top up with dividends. Dividends are paid from post-tax profits and are not a company expense. That's true. They attract no NICs and are taxed at lower rates than salary. Again, very true. 0% on the first 500 dividend allowance. I agree with that. 8.75% in the basic rate, 33.75% higher rate, and then 39.35% additional rate. And it says here, the aim is usually to stay within the 50,270 total income threshold to avoid the higher rate dividend tax. I agree with that. That is absolutely spot on. That's what a lot of clients do. They want to play with the 50,270 to avoid becoming a higher rate taxpayer. And it's also actually added some other suggestions as well. Use tax-free benefits. Consider legitimate company paid benefits, mobile phone, trivial benefits, company pension contributions, mileage allowance, 45p. Yep, okay, these are some great extra tips. Contribute to a director's pension. Employer pension contributions are corporation tax deductible, no tax or NIC for you personally. And your allowance is usually 60k, can be more carried forward. Builds outside of your estate for IHT and gross tax free. I mean, it was all good up until that point, but as we know, with the pensions, they are now subject to inheritance tax from next year. You know, they're part of your estate. So that could be a big one. If you were solely relying on this, that could be a massive boo-boo. You think that, you know, you've got a lot of money sitting around, we're going to put it into a pension, it's going to grow tax-free, which it does, and ultimately be outside of your estate for IHT. That's no longer the case. And I suppose that's what when I use ChatGPT personally, I often see that the information is just a little bit too outdated. It doesn't have the right tax rates. That's one of the biggest things that it gets wrong. You know, well, it's the thing that gets wrong the most often. There are quite a few things it does get wrong when I use it on a day-to-day basis, but it's the outdated information that takes a while for it to update is the biggest thing that we see. Then we've got some more. It said here, reimburse business expenses. Yeah, consider a director's loan short term. You can borrow money interest free from your company up to 9 months without Section 455. Useful for short term cash flow, but must be handled carefully. Again, there it's missed a big one. If a loan is over £10,000, well, actually, you've got to pay HMRC's official rate of interest. Otherwise, there's a benefit in kind. So it's right about the 9 months year end to avoid the Section 455. But actually, if you were to borrow money over 10k, you've got to have that interest charge. Otherwise, there's a benefit in kind. Then we just got here, common mistakes to avoid. Taking large personal spending directly from the company account, treated as drawings or loan, triggers tax. Yeah, that's sound advice. And then not planning dividend timing correctly and pushing into higher rate tax bands. Missing pension opportunities for long-term efficiency. So, you know, there's a lot of good advice there, or a lot of good information, general tax efficiency, but ultimately it's not as accurate as you need it to be. If you would have, again, blindly followed this as advice, you could be paying some employers national insurance, not too bad, because actually 12,570 is still the most tax efficient salary. But the big one there is you could be putting money into your pension thinking it's tax free for inheritance tax. So that could potentially cost you hundreds of thousands in IHT. So I think for this one, we're going to rate ChatGPT's response probably a 5.5 out of 10. Okay, so we'll pop a couple more questions in. So here's more of a general one. So we've got, how can I avoid inheritance tax? Yeah, great question. Open up a new ChatGPT here. How can I avoid inheritance tax? Let's see what it comes up for this one. So we've got avoiding inheritance tax legally in the UK requires strategic planning. Absolutely, I agree with that. Here are some of the most effective ways to reduce or eliminate IHT. So we've got the first one, use the nil rate bands. 325,000 per person is tax-free. That's correct. An extra $175,000 is available if you leave your main home to direct descendant, residential no rate band. Couples can combine allowances for a total of £1 million. Yep, that's absolutely right so far. That's the basics when it comes to inheritance tax no rate bands. And then we've got make gifts early. So gifts survive 7 years. If you gift assets that survive 7 years, they fall outside of your estate. That's right, potentially exempt transfers. Use your annual exemption, $3,000 per year, and small gifts allowance, $250 per person. Wedding gifts of up to $5,000 per child are also exempt. Yeah, absolutely can't agree with that. I suppose the main thing there is gifts. We need to, a big part of inheritance tax planning is actually looking at what gifts you can give away, because the last thing you want to do is gift something that triggers a chargeable transfer. So if you gift a investment property, well, actually you can end up paying 24% capital gains tax on that gift, which actually negates a large part of the inheritance tax planning. So you need to consider, well, what to gift. Is it a gift of cash? Because we don't just look at one. When we plan for taxes, we don't just consider one tax. We need to consider them all to make sure that all taxes are minimised and wealth is maximised. And we've got a few more points that's covered here. Use trusts. Certain trusts, like discretionary trusts, can move assets outside of your estate. Yeah. Trusts require careful planning. It can trigger entry charges or periodic charges, but powerfully set up right. I mean, that's right. It doesn't tell you enough information there. It's just a very, very brief point. When it comes to inheritance tax planning, trusts are a powerful tool, but you need to fully understand those entry charges and those periodic charges, well, the anniversary charges. And then we've got giveaway income. So if you have excess income, you can gift it regularly without IHT consequences under the normal expenditure of income rule. And it rule must be regular and not affect your standard of living. Yep, that's a great point. I suppose there you need to understand, what does impact your standard of living. You need to understand the actual rules around it to make sure that it doesn't impact your standard of living. HMRC can be quite strict in this area, and looking at what extra cash flow, excess cash you have. And we've got a big one here. This is a big no-no. I think, it wasn't doing too bad up until this point. Invest in business relief assets. Shares in qualifying trading companies, AIM-listed shares, furnished holiday lets can qualify for IHT relief after 2 years. Great for passing on value without triggering IHT. ChatGPT, you've led us down on this one. So as we know, business property relief has changed massively recently. Qualifying trading companies, AIM-listed shares, furnished holiday lets, very, very rarely had business property relief applied to them in any case. It was very, very tough to actually get BPR. In most of the cases, HMRC ruled against there being BPR available. So for that, it was wasn't available anyway. So if you had a furnished holiday let business, planning for IHT, you thought, no worries, ChatGPT's got us business property relief, you would have been caught short there. But for the AIM-listed shares, for the trading companies, we've now got that 1 million cap, and then it's 20% above that. And then we've got pension planning. Most pension pots are outside of your estate for IHT. Well, as we saw earlier, that's not true anymore. Leave pension funds untouched where possible and pass them to beneficiaries free of IHT. 7, use a family investment company, a structure that allows you to pass wealth efficiently and maintain control. Growth happens outside of your estate while retaining some control over the assets. Yeah, that sounds spot on. Wouldn't surprise me if ChatGPT is taking this from one of our articles or YouTube videos. Life insurance in a trust. Life insurance won't reduce IHT, but putting it in a trust can cover the IHT bill, leaving your estate intact. That's right. Number 9. Okay, this is a very good point. Change domicile. It's got complex there. If you are non-UK domiciled, only UK assets are subject to IHT. Long-term residents can be deemed domiciled. This is a specialist but highly relevant area for some. So it's missed out there about how to become non-UK domiciled, the new 10-year non-residence rules, how you can ditch your UK domiciliary. But overall, there are a lot of good points there. But ultimately, you've got a few bad points. The business property relief, the pensions, not going into detail about the domicile. So it's very hard to actually give ChatGPT a good score, because the purpose of this was to kind of highlight that if people solely take tax advice from AI, from ChatGPT, not a tax advisor, well, actually, what would the difference in circumstances be compared to someone who works only with a tax advisor, doesn't use ChatGPT, someone who solely uses ChatGPT? Well, here the tax bill would be astronomically different, because one person would be paying business property trying to claim business property relief on their furnished holiday let or their AIM shares, which would cost them hundreds of thousands, if not millions, for a wealthy entrepreneur in inheritance tax. The same with the pensions as well. So I think for this one, there's a lot of good stuff, but also if you're solely relying on it, it would have cost you a fortune. So we're going to give this a solid 4 out of 10 for this ChatGPT response. Okay, so we'll do a couple more questions, just really put ChatGPT through its paces. So we've got one here. If I bought a buy-to-let property in 2006 for £100,000 and sold it today for £200,000, what would my capital gains tax be? So this one, it's quite. There's not too much that's changed in terms of tax law legislation. It's quite kind of a normal question. It's more calculation based. So there might be a good chance that ChatGPT actually does a good job when calculating this one. So here's how you calculate the CGT on your buy-to-let if you bought it for 100,000 2006 and sold it today for 200. So first off, it does the CGT calculation. Fantastic. Sale proceeds 200 less purchase price. It's great here. Kudos to ChatGPT for saying allowable deductions. Some accountants that we see actually miss this. So you can deduct stamp duty, legal fees, estate agents fees, and improvements, not repairs. Fair play. That's you got to give it some credit for that one. It says that let's assume 5,000 of costs, adjust if you need the exact numbers. So actually it's brought that total gain down to 95,000. Apply the annual exemption. So for 24-25, well actually, we're in 25-26, but as ChatGPT and AI does get a lot more powerful, that the information will be a lot more relevant. But it's got the 3,000 annual exemption here. I suppose the good news in the good news for ChatGPT is this number hasn't changed this year, so it's a good response. Tax rate, as this is residential property and assuming you're a higher rate taxpayer, CGT is charged at 28% for higher and additional rate taxpayers, 18% for basic rate. Well, it's unfortunate there that actually the 28% has changed. So if you were a higher rate taxpayer relying on this, the 28% is calculating your CGT actually more than it should be. And it gives you there 92,000 because you've got your improvement costs and your allowable expenses, less your annual allowance, times by 28%, saying about 25,000 of CGT payable. And it breaks it down there. And it says if you're a basic rate taxpayer, part of the gain may be taxed at 18% depending on your other income. I mean, overall there, it's not a bad response. I suppose a lot of it was actually the information's changed, the rates have changed, but it did kind of think to put forward about those allowable deductions. So if you hadn't have put that in, well, we didn't put that into the question, so actually ChatGPT prompted you to say, actually, you can deduct these. Other feedback is, well, actually, you could have transferred some of this property to your spouse prior to sale, unlocked a second annual allowance, unlocked a second lot of lower tax rates if they're a basic rate taxpayer. But overall, this one is a much better response than the previous, where we were talking about business property relief and the kind of the scope of the error effectively in ChatGPT's output. So I think this one, again, solid 5 or 6 out of 10 in terms of the response. Of course, if you relied on it, well, actually, all that would be wrong would be you would have paid a little bit more CGT than you ought to have. But actually, if you did the CGT return, you put these numbers into HMRC, it wouldn't have let you pay more tax. But you would have thought that you had a higher tax bill than you actually do. So there we have it, guys. We put quite a few different questions into ChatGPT. We had a mixed output. Some responses have been excellent, as per the last one. That was an excellent response. Some responses haven't been accurate, and if you would have relied on them, actually, you would have potentially paid far more tax than you ought to. So I suppose the thing here is, ChatGPT can be okay, but when it comes to taxes, you want to be sure. And with AI, unless you're a tax advisor who can, sense check what it puts out, you're never going to be sure that that is the best advice. If a tax advisor gives you the wrong advice, well, actually, they've got professional indemnity insurance. You can sue them, be put back to the same position where you were if you didn't take their advice or you took the right advice. But for ChatGPT, you can't sue them, unfortunately. So I would say, for sure, use ChatGPT for your day-to-day. But for anything complex, speak to your accountant, speak to your tax advisor, because you just don't know what you don't know. And when it comes to taxes, that can cost you money. So there we have it, guys. My thoughts on ChatGPT. We put it through its paces, and ultimately, we've learned a lot about how it's good and where its kind of downfalls are. Hope you find this video useful. Please do smash that subscribe button, give it a thumbs up. Until next time. Bye for now, guys.